All right. Hi, everyone. We are here and we are looking at variable costing. Variable costing is another way to cost your products or your inventory. And it's going to be in contrast to what we had been learning under what is called absorption costing. One thing that I really like about accountants, and I can say this because I'm an accountant, is that we are not overly creative. So these titles, absorption costing and variable costing, give you a lot of information. Okay. I like to think of absorption costing as the idea of a sponge. Okay. Under absorption costing, your product absorbs all manufacturing costs. In other words, if there is a cost that happens in the manufacturing facility or the manufacturing floor, whatever you want to call it, under absorption costing, it will be a product cost. This means all direct material, all direct labor, and all manufacturing overhead. Okay, imagine that sponge soaking every cost that happens in the manufacturing facility up into the value of the product or the inventory. Variable costing, on the other hand, again, this title is very useful. Okay? Rather than absorbing all manufacturing costs, not surprising, okay? Variable costing, your product is made up of variable costs only. At this point, you know that direct materials is a variable cost and direct labor is also a variable cost. But now, instead of just saying all manufacturing overhead, okay, over here I said manufacturing overhead, but you also know manufacturing overhead is made up of both a fixed and a variable portion. Okay, under absorption costing, the product absorbs all overhead, fixed and variable. Okay. But under variable costing, we don't absorb all those costs. Instead, the product is just made up of the variable costs, which are direct material, direct labor, and then variable overhead. All right. So, although this is not a major difference, it does have big implications in our product cost on a per unit basis. And it will also have implications in terms of the calculation of our income and our inventory values. But all these differences come from the treatment of one thing and one thing only. That's the fixed overhead. So let's progress and see what we have here. Some reminders, okay? What we just said, variable costing includes the variable items, direct material, direct labor, variable overhead. Absorption costing, we could list these things out, but we could simply say absorbs all manufacturing costs. Okay? We learn about absorption costing when we first learn about job order costing. Okay? Absorption costing is not new. We've seen it already. But we learn about this first because absorption costing is what is required by GAAP or for external accounting purposes. So why bother with variable costing? Okay. It's because it can provide us with very useful information for internal business purposes and decision making. All right, so let's go on. This is just a nice picture of all the costs that could be incurred at a company and how they're treated under the two methods. Okay, sorry, these are not all the costs. These are just the manufacturing costs. Absorption costing absorbs all manufacturing costs. We could label this manufacturing costs. I'm going to abbreviate. All of them are product cost under absorption costing. However, just these three variable items are product costs under variable costing. Okay, maybe I said that backwards. Now that I'm thinking. Just now, I said all costs, all manufacturing costs are product costs under absorption costing. I think right there, I might have said the wrong title. If so, I'm sorry. Okay. And then over here with our variable costing, we just have those variable items. The question is, what about our fixed overhead? Remember, costs are either product costs or period costs or period expenses. So in variable costing, when fixed overhead is not a product cost, that means it's a period expense. We don't see it listed here, but in either method, okay, our selling or our general and admin expenses, okay, these categories, these are always period expenses under both methods. So again, everything that we're looking at is a difference caused by this treatment of this one item. Nothing else differs. It's just this one item, but it does have some major implications. So let's look at calculating our product cost under each method. First things first, let's look at what's the same. Okay. They tell us $4 of material, $8 of labor, and $3 of overhead. These are our variable items, and we know that they are product costs under each method. So you see here, 4 and 4, 8 and 8, 3 and 3, no difference. But our absorption costing product cost includes an extra $10. You can see here, they're telling us this is $10 per unit, but I also want to make sure you know how to calculate that. It's given to us on a per unit basis, but oftentimes you have to calculate this. Fixed overhead is often told to you in total. So if you want to get that per unit, you're going to take $600,000 of total overhead in this case. You want to divide by units produced. In this case, it's 60,000 units. So that is where that $10 per unit came from. Okay. We don't have it on this page, but I want you to be very careful. When you're calculating overhead on a per unit basis, make sure you divide by units produced. Later on, when we're calculating income, they'll tell us units produced, but they'll also tell us how many units we sold. When you allocate overhead, it's allocated over everything we produced, not what was sold. Again, right here on this page, we're not told anything about units sold, but I just want you to be aware that you have got to be able to differentiate between, do I divide by produced or sold, because it would make a difference. So let's go ahead now that we've talked about those product costs and look at our income statements. One thing you'll notice is absorption costing. We're going to calculate income and put together an income statement using your traditional income statement. Variable costing, on the other hand, will calculate income, but the format of the income statement will be the contribution margin income statement. And that's because absorption costing mixes fixed and variable manufacturing costs in that one cost of goods sold line item. Absorption costing requires the use of the traditional income statement. The reason we cannot use a traditional income statement with absorption costing, the reason we cannot use a contribution margin income statement with absorption costing is because a contribution margin income statement requires you to split out your fixed and your variable costs. By nature, absorption costing mixes fixed and variable items in cost of goods sold. Therefore, you cannot do a contribution margin income statement with absorption costing. We must therefore use a traditional statement. I'm going to abbreviate income statement. With variable costing, we can do a contribution margin income statement. Why? Because a contribution margin income statement separates costs by their behavior, which is precisely what we're doing with variable costing, because our cost of goods sold is only going to include variable costs. So let's go ahead and let's look at what we have. We're given some information, and you'll notice here that we're told information for 3 years of data. You'll notice that we have units produced and units sold for each year. In year 1, we produced and we sold the same number of units. And when this happens, our traditional income, or not our traditional, our absorption income and our variable income will be the same. But that only happens when what we produce and what we sell are equal. In years 2 and 3, what we produce and sell are different. In year 2, we produce more than what we sell. In year 3, we sell more than what we produce. Essentially, this means in year 2, we had some inventory left over, excess inventory, but that extra inventory was sold in year 3. In year 3, essentially, we sold all 60,000 units that we made in year 3, plus we're going to sell those 20,000 from the prior year. That's how you can sell more than what you produced. Okay. When we have a difference in what was produced versus what was sold, for example, in years 2 and 3, our absorption and our variable costing income will be different. Okay. The key is that under absorption costing, we have to remember that our product cost or our inventory values carry all the variable costs as well as the fixed overhead. So under absorption costing, if there is inventory left over, that inventory that is left over absorbs the fixed overhead that is part of these inventory values. That doesn't happen with variable costing. So in years when we have inventory left over, what we'll find is absorption income will be higher. But when things reverse later on, for example, in this case, in year 3, when we sell those old units, in that case, everything will reverse and we'll see absorption costing income ends up lower because the costs previously deferred, specifically the fixed overhead, will then get recognized in that next year. So let's go ahead and look. You can see the two income statements. Note here the different formats. Absorption costing, you've got your traditional statement. I know this is traditional because a traditional statement is going to show gross profit. And the key is a traditional statement separates cost by their function, meaning what do these costs do? We've got cost of goods sold. And then down here, we've got all selling and admin. Over here, we've got that contribution margin income statement. I'm just going to abbreviate. And I know it's a contribution margin income statement most obviously because it says the word contribution margin, but also because we're separating our expenses by their behavior. Variable ones here, fixed down here. Another thing to note is in all of our income statements for years 1, 2, and 3, our sales are always the same. What we're doing is we're costing our inventory differently, and that has nothing to do with revenue. So in all cases, revenue will be the same. In this instance, when we sell and produce the same amount, you'll notice both of these result in the same net income. In years 2 and 3, you'll notice net incomes will be different. But in year 1, when what we sell and what we produce is the same, we have the same result. So all we're doing is we're analyzing our expenses differently. You can see here cost of goods sold under absorption costing, 60,000 units sold at $25 per unit. Remember, this is what we calculated earlier. Over here, we've got $60,000 multiplied by $15 per unit. So cost of goods sold under absorption costing is higher, $1,500,000. Over here, it's lower because of that lower product cost. It's $900,000. Remember, the $900,000 here includes direct material, direct labor, and variable overhead per unit. Over here, this cost of goods sold, I'm going to have to write it up here, is direct material, direct labor, variable overhead, and fixed overhead. That's why it's higher, because it includes the fixed overhead. But what I want you to understand is although fixed overhead is not part of your variable cost of goods sold, it doesn't mean it's ignored. It's just showing up in a different place. Here's this fixed overhead, $600,000. All of it's there. If we actually add up $900,000 plus $600,000, that adds up to that same $1.5 million. Okay, so we're recognizing the full fixed overhead in both circumstances. It's just in different lines. The reasons years 2 and 3 will have different income is because under variable costing, this fixed overhead is a period cost, which means in all instances, all 600,000 will be recognized for each year under variable costing. However, under absorption costing, not all 600,000 is going to be recognized in year 2. Why? Because in year 2, when we have inventory items left over, those leftover inventory items are going to be carrying $10 of fixed overhead per unit, which means that overhead won't get recognized under absorption costing in year 2. Everything will reverse in year 3, but we'll see that in a minute. Let's keep going. Here is year 2. Okay. We've got the same product costs. We could go back and recalculate those, but they're the same. Okay. Notice we're starting with the same revenue. Okay. Both instances, revenue is simply $40 multiplied by 40,000 units sold. So how is it that our incomes are different if our starting points are the same? All right. Under variable costing, we've sold 40,000 units at their cost of $15 per unit, and all overhead, meaning 100% of it, has been recognized. The difference here is that under absorption costing, we have sold 40,000 units, but we left some inventory unsold. If you'll remember, it was 20,000 units unsold. 20,000 out of 60,000 units means there's about 33.33%, I'll round, units unsold. And under absorption costing, when things are not sold, that means that those inventory items are carrying their share of that 600,000. So I could multiply that 33.33% by 600,000. And this means there is 200,000 of expenses not on this income statement. Another way we could do that is simply say, well, 20,000 units that are unsold, and they're each carrying an extra $10 of overhead, also adds up to that same 200,000. Sorry, guys, I'm recording here at home and someone knocked on the door. Got my dog worked up. I think he'll be quiet in a second. Alrighty, so the difference is a $200,000 difference, and that is the result of fixed overhead. All of the fixed overhead is showing up in this line item here. Okay. If we add up 600,000 and 600,000, we're talking about 1.2 million of manufacturing costs being recognized over here. However, over here, we're only recognizing 1 million. Okay. Remember last year, we had 1.5 million recognized, and the sum was also 1.5 million over here. That was because we sold and produced the same amount. When we sell less, absorption costing is going to keep that $10 for each unit left over off of the income statement. Therefore, we have higher income. All right, I'm going to have to pause this because he is not being quiet. Bear with me. All right, moving on. Let's go ahead and look at the next year. Okay, this is year 3, and everything's going to reverse. Remember, in year 2, when we left old inventory on the table, absorption income was higher. Well, now when we sell that old inventory, the costs previously deferred are now recognized. And that's why we see absorption income being lower than variable income. It's also not surprising that it's a $200,000 difference. Why? Because the difference was $200,000 last year when those 20,000 units were not sold. And now this year, when they are sold, we get those extra expenses. They're all showing up over here under absorption costing. Okay. Again, we're starting with the same revenue this year. Okay. Under variable costing, We've got 1.2 million of cost of goods sold and that same 600,000 of fixed overhead. So we're talking about 1.8 million being accounted for here. But over here, we've got 2 million. It's a it's a $200,000 difference, which is exactly what we see in our bottom line. What causes that $200,000 difference? Well, we have got cost of goods sold of 80,000 units, but those 80,000 units are pulling an extra $10 of old inventory for the fixed overhead in excess of what we're seeing over here. All right, so moving on, we've got a summary of what happens when what we produce and what we sell is equal. Our incomes are equal. When we produce more than what we sell, in other words, inventory left over, absorption income is higher. And when things reverse and we sell that old inventory, variable costing will be higher. All in all, everything washes out the same. We do have different incomes from one year to the next, but in the end, we're recognizing all of the same expenses. It just happened in different time periods. You'll get plenty of practice with this as you go through your homework. All right, I'm going to keep moving on. You can see some discussion about some of the downsides of absorption costing. The bottom line is when a company knows that they can essentially hide costs or bury them in a particular year by overproducing, absorption costing can actually encourage overproduction. This is not a good thing in the long run or the health of the company in the long term, but it can provide them short-term gains or benefits, boosts in income. But companies have to be careful about that. It's not a good practice to overproduce. All right, moving on, let's look at what we call target pricing, okay? I'm about to wrap all this up, but I just want to mention that we have target pricing, which is essentially a way to price where we move backward. A company chooses, or they don't choose, sorry. A company is generally going to do a good bit of market research to find out what their customers want, what their customers are willing to pay for their product, and then they're going to design that product in an opposite direction of what you normally think. Meaning we take what our customers want, what they're willing to pay, and we design our product in our manufacturing process to meet those needs. This is in contrast to your traditional cost plus pricing, where companies first build the product and then they mark it up to make money. Again, we're just working in the opposite direction. It's more customer centered. All righty. So I am going to finish up here. You will get lots of practice as you move through the homework. Just note that you are going to have to be careful with organizing your work, keeping track of your various product costs, and making sure that you are focusing on creating absorption costing income statements using your traditional statement, and variable costing, you'll be using that contribution format.